Hi, I'm Mark Draper from Gem Capital. Today we're talking about dividend imputation. So what is it? Dividend imputation is it's a corporate tax structure that allows tax paid from a company to be attributed to shareholders so that they can offset it against their own tax liability. Or put another way, it's a way of ensuring that you're not double taxed on dividends from Australian companies. If you didn't have dividend imputation in Australia, you would have a situation where the company pays tax at 30% and then you would pay tax again at the individual level. So let's now have a look at how it works. If you can understand dividend imputation, you're in the top 1% of Australians because it's the most misunderstood investment concept, I think, going around. Let's have a look at an example to try and simplify it though. Consider a company that makes a $100 profit. They then pay tax at 30% tax rate, which means they're paying tax at $30 on their $100 profit, which leaves $70 to distribute to shareholders. So that $70, when it comes to do your tax return, you'll pay tax on the $70 in addition to what the company has already paid in tax. Or in other words, you'll pay tax on what the company originally earned, and you'll pay tax on that amount and get back what the company paid in company tax. So with $100 on your tax return, if you don't pay any tax, then you'll get a $30 tax credit back, which is how much the company has already paid. So the bottom line is that the company pays tax at 30%, you pay tax on it. If your tax rate's lower than 30%, you'll get a tax credit to offset against other income. And if you're on a 30% tax bracket, it's actually tax-free. Let's look at a real live example. Let's consider someone who's got $10,000 worth of fully franked dividends that they've been received as income. What they would pay tax on is the $10,000 they've received in their account plus the $4,285 which the company has already paid to the tax office on the profit before they paid it to the shareholder. So this person's taxable income is $14,285. What's their tax liability on that if that was their only source of income? The tax they would pay is $1,242 less a low income rebate of $1,500, which cancels out the amount of tax anyway. And what that leaves is $4,285 of imputation credit, which this person would then get back as a tax refund. So the point here is that this person receives $10,000 in dividends and will also receive a $4,285 tax refund from the tax office. So what it really means for investors is that to get the pre-tax equivalent income rate on a term deposit from a fully franked dividend, you just simply multiply the fully franked dividend by 1.4285, let's call it 1.43, and that'll give you what the equivalent rate of income is off a cash or term deposit. So for instance, if you've got a 5% fully franked dividend, that's the equivalent of a 7.1% income rate on a term deposit. And I think the other key thing for investors to appreciate is those who are on a 30% tax bracket, really fully franked dividends are tax-free in their hands. Whereas those investors on a lower tax bracket than 30%, which includes a lot of retirees, certainly includes superannuation funds and superannuation funds in pension mode, then it really means the income that you're getting from Australian shares is better than tax-free. It's a very powerful way of maximising investment value, investing through companies that pay fully franked dividends, and we'd really encourage you to get your head around it.